Well, to talk about the upcoming budget is Kevin Page, Canada's first parliamentary budget officer. He served in that capacity from 2008 to 2015. He's gone on to found the Institute of Fiscal Studies and Democracy. He's also the CEO of that institute, which is at the University of Ottawa. Kevin Page, thank you for the time.
Great to be with you, Michael.
Listen, I'm going to begin here with that, I guess, the conservative ask of today. That open letter, comments being made today, that they want the Carney government to limit the federal deficit to $42 billion. And, essentially, that would keep it in line with the deficit outlined in the Trudeau last budget tabled April of 2024. Is that a responsible deficit limit? Is that even possible to achieve?
Yeah, I don't think it's possible to achieve at this point. I think like what we heard from the parliamentary budget officers, that the new baseline for this year is probably a deficit closer to $70 billion. So and we started with a deficit of $42 billion. The economy got weaker. There were a number of platform initiatives, in both the conservative and liberal platforms. So, we think we're probably looking at a deficit in the 70s, maybe $75 to $80 billion range. And again, in the context of an economy that is really not growing very fast, very sluggish, I think having a deficit, in this sort of 1.5 to 2.5 range is probably pretty healthy to stabilize the economy.
Mm-hmm. Healthy to stabilize the economy. But what about this $42 billion mark? Would that be a responsible target?
No. Yeah, I think effectively last year we ran a deficit of $50 billion. The economy was growing faster than it is now. Now the economy is obviously growing slower. We're actually talking about shrinking the deficit, and it would mean we'd have to put in some significant restraint measures. And again, this is not a good time to do that.
Okay. Except that the current PBO, we heard him speak out a few weeks ago, essentially raising alarm at a deficit figure that he pegs at around $70 billion. Why don't you share the concerns that we heard from Monsieur Jacques?
Yeah, so I think it's, well, first of all, those concerns that we heard from the interim parliamentary budget officer, Mr. Jacques, were actually not in the report. So he released a fine report. This is the baseline deficit of about $70 billion, pretty much staying flat, maybe shrinking a little bit to $60 billion in the years ahead. And there was no sustainability analysis in it. There was no strong language in it. And I think a $70 billion deficit for Canada is a little over 2 percentage points. Given the weakness of the economy, the unemployment rate has risen to over 7%, probably going to grow around 1% this year. It's very weak output growth. I think that size of deficit relative to other countries, the United States in the 6 to 7% range, same for the United Kingdom, probably the average deficit in the G7, G20 is in that 5 to 7% range because of NATO commitments, because of weak economies, because of a slowing global economy. I think it's not a major problem. If you look at this size of this deficit relative to our history and relative to other countries, Canada's a AAA country. No one's seeing any that kind of alarm.
Okay, let me rewind a bit, because when you're talking about 2%, 5%, what you're talking about is deficit to GDP ratio.
Correct.
Okay, so that puts into context the numbers or the ratio that you have in mind. And it seems to be you're making the argument that now is actually a time to invest rather than to save. Why?
Yeah, I think it's. I think the Prime Minister uses this word, a hinge moment, and effectively a crisis that we find ourselves in. Certainly, with respect to the changing relationship with the United States, Canada's tight trading relationship with the Americans is, this is being fractured at this moment. There are a lot of others, we think fractures, I think in the economy. Socially, economically, even with military spending, we've been underspending on the military for a number of years. We have to deal with some of these issues. I don't think we can delay, and I think that's the view of the government. And at this particular juncture, I support that view.
What's the opposite, though? If the government were not to invest and spend this much in this moment in time, what's the downside of that?
Yeah, I think it's becoming quite apparent that Canada and other countries as well, not the United States, though, we're suffering from this sort of longer-term growth problem, weak investment, and effectively real business capital formation for a number of years now has stayed completely flat. So we're not attracting private sector business investment, and the public sector investment has been it's been modest, but it's not, it hasn't been in the area of infrastructure, particularly, or innovation that's going to make a big difference. So, I think even some of my former bosses, like Mr. Dodge, who was the governor of the Bank of Canada, former deputy minister of finance I worked for him, said, the crisis that we find ourselves now, he was saying, was even bigger than the crisis we found ourselves in the 1990s after a Quebec referendum, dealing with a very high deficit. Our problem right now is not the deficit. It is really, it's about growth and dealing with some of these longer-term structural issues.
I think people would be surprised about the problem not being the deficit, because again, if you're pegging it at around $70 billion to $80, $85 billion, that is about double of what was projected by the last government in the last tabled budget in April of 2024. How is that not concerning?
I think, first of all, when I was at Department of Finance in the 80s, every year we ran deficits relative to the size of the economy, GDP, probably in the 5-6% range. So this, the kind of deficit that we're talking about now, in this context of this crisis, this hinge moment, this fracturing relationship with the United States, the need to kind of open up new trade corridors, east and west. It's to run a deficit at 2.5% when the economy is growing about half of its potential right now, not a huge problem. So, I think that there is issues. It's you shouldn't be, I shouldn't underplay with respect to debt interest costs. Because of COVID, the government ran up a significant amount of debt, so we're going to see interest costs rise significantly in nominal terms and as a percent of revenues, a percent of GDP. So that has to be monitored. But even when we look at those interest costs now and we compare them with the size of our economy or revenues, and we go back in time, they're still very modest. And so I think whether it's the director of the International Monetary Fund, or it's I think the bond rating agencies, when they look at Canada, they see a AAA country. They see a country that has this history of correcting itself over time. I think even in the part of the Prime Minister's platform, it's we're going to run some higher deficits, but we're going to get to something called an operating balance in 2028-29, and that we'll have a declining debt to GDP ratio over the long run. And if we could hit those targets, I think we're in great shape.
Okay, when you say operating budget, that does point to something very interesting that we're going to see in this budget tabled by the Carney government, because we know that already they're going to split essentially operating budget from capital budget. Conservatives have called that accounting trickery. Why should we have any faith in that?
Yeah, so I would disagree with the conservative interpretation of it. It's not even accounting. It's really just a reporting change that we're going to, a reporting change that's going to lead to new fiscal targets, which I think is a good thing, which I think the conservatives should support. So I think, again, the idea that the government is putting out, which exists in other countries, which actually exists in some of our provinces, is we shouldn't be deficit financing current consumption. Transfers, to senior citizens, transfers to unemployed people, child care programs, even transfers to provinces, grants and contributions that are going to be consumed in that year. But so we finance that every single year. We pay for that as we go. But the idea of deficit financing, running a deficit of 1 to 2 percentage points of GDP that is focused just on capital formation. So investment in infrastructure, particularly investment in military equipment, investment in research and development, I think is seen widely as something that we desperately need, given what's happened to investment in this country for the past number of years.
Okay, if I'm hearing you correctly, then by what, showing responsibility on the operating side, it gives bond rating agencies, investors greater confidence on the capital side?
Well, I think bond rating agencies are going to look at a number of factors. They'll look at the overall deficit. They'll look at the financial requirements of the country. They'll look at the level of debt. They'll look at our financial assets. They'll look at the strength of our institutions. But they will look at those capital investments and as well. So if we are going to be spending money on LNG, production, if we're going to be spending money on fixing ports, opening up new ports, on rare earth mines, that they're going to look at the quality of those investments. Is there going to be a return for that? And we need that in this country. We don't have that, and we're going to need those investments and a lot more. And so I think what the Prime Minister is saying, what the government is saying, is that we'll deficit finance just that capital investment, but as we'll pay as we go with respect to current consumption.
Okay. Well, of course, we're now about 2 weeks away from the budget itself. We'll speak again. Kevin Page, thank you for this.
Good to be with you.